Now, looking at, moving forward to the forecast and looking at this market, I mean, Obama, they can be hoping for a V-shaped recovery, but we don't see that in the market right now. In fact, we think it's, as we say, that count on count type recovery, or even at worst, maybe it's that double dip recession. So when we look at the current markets, definitely not sort of a V-shaped recovery. Now, when we look going out forward into our forecast, one of the things that we think is very important is the deleveraging process that needs to take place in the market. Now, one of the sources that we use in order to get a handle on this was a study done by McKinsey and Company. They looked at 45 episodes of deleveraging since the Great Depression and then concluded that 32 of those had followed a financial crisis, which is exactly what we think we're going through right now. So this seems to make sense. They say it plays out in one of four ways. Either it's resolved through belt tightening, which is basically less government spending, higher taxes, high inflation, massive default, or growing your way out of debt. The two most prevalent ways are the ones we're going to talk about today, which is belt tightening and high inflation. We can talk about the other two during the question and answer if people have questions. This next graph shows how that we got to the stage where we need to deleverage. This shows that from the period 2000-2008, it shows advanced country household debt as a percentage of disposable income. The red bars are 2008, the blue bars are 2000, and you can see how much growth we've had from 2000 to 2008. And what that's really indicating is that, and the point we want to get across with this is it's not just the US that has had that buildup in household debt. It's every country. In fact, the only two countries that had a decline from 2000 to 2008 was Germany and Japan. Everyone else increased, including the US and even Canada, which is even higher than the US. We're going to sort of talk about that later on. Now, because of all that debt, we're now embarking on a deleveraging process. And in the US in 2009, bank loans declined 7.4%. This is the largest decline in bank loans since the 40s. And a lot of that, unfortunately, is people, because household debt, a lot of it is mortgages. That's people defaulting on their mortgages. But it's also people cutting back, people increasing their spending, or rather increasing their spending and spending more. It's that deleveraging process, which is good and good for the economy, or rather, it's good for the consumer balance sheet. The problem with it is it's also deflationary. This is what McKinsey and Company call belt tightening. And it's, again, bad for the long-term growth. And if there's one graph to remember from the presentation, this is it, because it's this deleveraging which is really going to put that overhang on the economy. Now, one of the things that we showed household debt is deleveraging. This graph is showing the amount of total country debt between Q2 and Q1 of 2009. Now, so total debt means it includes government debt and household debt. And you can see what's interesting is we talked about deleveraging, but you can see from this graph, there's not a lot of deleveraging happening. In fact, for most countries, it's still increasing. And there's Canada and the US, especially Canada is increasing. So why is that? If we talked, and we've shown the graph, you've seen the deleveraging in the household sector in the US, why are we not seeing total country debt decline? Well, it's because of this. This cartoon says the recession was created by people spending money they didn't have and can only be fixed by the government spending money it doesn't have. And that really is the essence of what is happening. In the US and in countries around the world, the governments are replacing consumer spending with government spending. Now, is this a good thing? What will this eventually lead to? Because one thing it is doing is delaying that deleveraging process that McKinsey and Group said that we need to have. So in order to get an idea of the implications of increasing government debt, we looked at, there's two Harvard professors that have done extensive research on government debt. In fact, they've just recently written a book on government debt, and they've collected 800 years of data on government debt. Now, you can buy this book from Amazon for $23, and strange as it may sound, it's on sale right now. I don't know why 800 years of financial debt, why people wouldn't want that, but there you go. Or you can download for free. They wrote a paper at the beginning of the year, and this is what I did, a paper called Growth in the Time of Debt. Some of the conclusions they've drawn is that of 14 post-World War II financial crises, severe financial crises, they have found that government debt has risen 86% on average. So the increase in debt that we're seeing, government debt around the world, is to be expected. They've also identified 5 countries that they feel are in a financial crisis right now: Iceland, Ireland, UK, Spain, and of course the US. And they found that debts are already up 75%. So, we're not even through this crisis, and already we're up 75% versus the 86% average. The US debt to GDP right now, according to this study, is 84%, and it's projected to go over 100% by next year. And why these numbers are important is because of the next graph. So keep in mind, remember that 100% number, or that 84% number, because what Rogoff and Reinhardt have found is that if you were to plot debt to GDP levels versus GDP growth, up to 90% debt to GDP, it's no impact on GDP growth. But once you get past 90%, and keep in mind the US right now in 2009 was at 84, they're probably, as we speak, over 90%, you find that it's a negative growth rate. And it's about a 4% difference if you get over 90%. And the US is almost right at the cusp of that. So this, again, is very deflationary. So again, not only do you have the deflation from the consumer deleveraging, but now you've got the potential overhang from too much government debt.